The U.S. economy, guided by the Federal Reserve, Fed, is the largest in the world, and this scale makes the Fed one of the most influential central banks globally. The strength and size of the U.S. economy are key factors behind the significance of the Fed's actions. The U.S. economy has been one of the fastest growing in recent years, further elevating the dollar's importance on the global stage. A country's currency does not gain global dominance overnight. The value of a currency is closely tied to the health of its economy. When economic conditions are favorable and the economy grows, the currency tends to strengthen as well. From 2022 to 2023, the Fed raised interest rates to over 5% to combat inflation, a trend followed by many central banks worldwide. This made borrowing more expensive, slowing economic growth in an attempt to ease rising prices. Across advanced economies, central banks tightened monetary policies at a rapid pace, with interest rates either matching or slightly lower than the Fed's rate of 5.5%. Higher interest rates generally strengthen a currency, and in the case of the US dollar, this led to its appreciation. However, higher interest rates also make it harder for workers to receive wage increases, which helps prevent inflation from spiraling out of control through wage price spirals. The Fed has long managed the dollar with the goal of maintaining its strength, and part of that strategy involves controlling inflationary risks. As the U.S. economy showed signs of slowing down by late summer 2024, central bankers began considering a reduction in interest rates. As the Fed moves to lower rates, they will likely align more closely with the interest rates of other central banks, which may influence global financial markets in the coming months. Changes in the Federal Reserve's interest rates can disrupt stock market strategies, and that is exactly what happened in early August. A sudden global market sell-off took place, triggered by a weaker-than-expected payroll report in the U.S. Although job growth was still positive, there was a slight increase in unemployment, which signaled a slowdown in the labor market. Investors who had anticipated stronger data reacted by abandoning strategies like the carry trade. One major strategy affected by this shift was the carry trade. The carry trade is a popular approach where investors borrow money in a currency with low interest rates and invest it in assets that yield higher returns. For example, an investor might borrow Japanese yen at lower interest rates and use the funds to buy U.S. assets like 10-year Treasury bonds, which offer better returns. When the carry trade works, the value of the assets purchased in the high-yielding currency like the U.S. dollar goes up. At the same time, the borrowed currency, such as the yen, stays relatively cheap. So if the dollar strengthens while the yen stays weak, investors can profit. But if things go the other way, this strategy can backfire. That is where the Fed's actions come into play. If the Federal Reserve unexpectedly cut interest rates, the value of the dollar could drop. At the same time, if another central bank, like the Bank of Japan, raises interest rates, the yen would strengthen. This narrowing gap between the interest rates of the two countries, known as the spread delta, can cause the carry trade to unravel. When that happens, investors rush to close their positions, which can lead to big swings in currency markets. The dollar index, DXY, which measures the strength of the dollar against a basket of major currencies like the yen, euro, and pound, has dropped to levels not seen in 14 months. The DXY was steadily above 104 points earlier, but has fallen to just above 100, a sharp decline signaling weakening dollar strength. This drop reflects both the impact of the Fed's rate cuts and the narrowing interest rate differential between the US and other major economies, such as Japan. The Fed's decision to cut interest rates came after 2 years of aggressive rate hikes aimed at curbing high inflation. At one point, inflation in the US reached 7%, but it has since dropped to around 2.2%. This success, along with stable unemployment rates and GDP growth, prompted the Federal Open Market Committee, FOMC, to initiate a new cycle of rate cuts. On August the 18th, 2024, the Fed cuts its benchmark interest rate by half a percentage point, marking the first such reduction in 4 years. This move was a signal that the Fed was shifting away from its previous tightening stance. Despite this shift, there remains uncertainty about whether the rate cuts are due to successful inflation control or rising economic risks. The Fed's decision to reduce rates has also weakened the US dollar, which had already been losing ground since mid-2023. The US dollar reached its peak value against major currencies in late 2022, and its decline began back in June 2024. Since then, the dollar has continued to slide, as seen in the falling DXY. The carry trade is not the only strategy impacted by the Fed's decisions. Investors across the board pay close attention to what the Federal Reserve does because it plays an important role in shaping global financial markets. Even though the Fed's main focus is on the US, its actions have a big influence on what happens elsewhere. The Fed's rate cuts are also part of a broader easing cycle, which is expected to drive further depreciation of the dollar. Goldman Sachs forecasts that the US dollar could fall to a 3-year low, with major declines expected against currencies like the British pound. The pound is expected to reach 1.40 against the dollar by next year, up from its current exchange rate of 1.33. The Fed's actions have also led to increased market volatility. On September the 18th, the volatility of the major currency pairs, including Euro and USD, spiked as the Fed's decision to cut rates was announced. The Euro-USD pair saw a fluctuation range of more than 0.8% on that day, reflecting investor reactions to both the rate cut and Federal Reserve Chairman Jerome Powell's subsequent comments. Brokers also reported increased trading activity across a range of financial instruments, including stock indices and gold. Gold prices, for example, tested new highs of $2,600 per ounce following the Fed's announcement. The yen carry trade, which has been popular among institutional investors, has also become less attractive as the interest rate gap between the US and Japan narrows. In July, the yen reached historic lows, with the USD JPY exchange rate hitting 162. However, the Bank of Japan's surprise decision to raise interest rates in the same month led to a sharp appreciation of the yen. As a result, the USD JPY exchange rate has fallen to 140, marking the lowest level in 14 months. The dollar's decline against the yen, losing 14% in a short period, has reduced the appeal of yen-based carry trades. Japanese investors, who have historically been significant buyers of U.S. government bonds, have also shifted their investment strategies. In the first 8 months of 2024, Japanese investors brought 28 trillion yen, $192 billion, of domestic government bonds, the largest such investment in 14 years. At the same time, their purchases of foreign bonds have nearly halved to 7.7 trillion yen, reflecting the reduced attractiveness of overseas investments. Some countries are even more directly tied to the US because they use the US dollar as their official currency. For these dollarized countries, changes in US interest rates have a direct impact. When the Fed tightens financial conditions, it can lead to a contraction in these economies, since their monetary policy is closely linked to what is happening in the US. The global role of the US dollar grants the Federal Reserve, Fed, major influence during financial crises. In today's interconnected world, disruptions in one country can quickly affect others, and the Fed plays a major role in stabilizing global markets. An important tool used by the Fed during such times is the swap line, which provides temporary loans from one central bank to another. This was very important during the pandemic, when the Fed extended swap lines to countries like Japan, ensuring dollar liquidity and preventing them from selling U.S. Treasury securities, which could have destabilized markets. Swap lines provide a buffer for international markets, slowing rapid fluctuations in currency values and preventing sell-offs of U.S. assets. The US dollar dominates global trade and finance, with a large portion of foreign reserves and exchange transactions conducted in dollars. During the pandemic, swap lines accounted for nearly 20% of the increase in the Fed's balance sheet. While China has extended its own swap lines, they are mainly used by countries that struggle to borrow in international markets. The US dollar, on the other hand, remains the dominant global currency. In 2022-23, the US dollar accounted for 9.3% of global trade, a substantial portion given that the US only represents about a quarter of global GDP, 25.4%. Furthermore, the dollar's share in foreign exchange transaction volume was a shocking 88.4%, showing just how widespread the use of the US currency is. It also made up 46.5% of international SWIFT payments, up to 13.1% points from 2012. Recently, de-dollarization has become a talking point, especially at the BRICS summit in 2023. However, despite discussions of alternative currencies like the Chinese yuan, the dollar's dominance continues. The yen accounts for only 3% of international SWIFT payments and has grown modestly in foreign reserves to 2.6%. The US dollar's role as the primary global currency allows the Fed to offer swap lines and stabilize markets during crises, protecting both the US and global economies. Countries that rely heavily on the dollar benefit from the Fed's willingness to provide liquidity during periods of financial stress, preventing large-scale sell-offs of U.S. assets. In recent years, several countries, especially China, have been trying to reduce their reliance on the U.S. dollar through different monetary strategies. China has been pushing its own currency, the renminbi or yen, as part of its effort to become more independent in global finance. Chinese companies are now major players in multiple sectors, competing with big names like Nike and Tesla. For example, Chinese brands like Li Ning and BYD have become major competitors in sportswear and electric vehicles, respectively. This shift is happening because China can no longer rely on its old growth model of increasing debt and investment. Instead, it is focusing more on exports to drive growth. At the same time, China is pushing to internationalize the yen. However, despite their efforts, the yen is still far behind the US dollar and the euro in global payments. Currently, the yuan makes up only 4.3% of global payments, though that number is slowly increasing. One of the reasons it has not taken off is that other countries do not see many benefits in holding yuan reserves. However, its use tends to grow when countries face US sanctions or other financial restrictions, as seen with Russia. China is also exploring central bank digital currencies, CBDCs, with the digital yuan being one example. While this could be part of the future, it's unlikely to replace the US dollar anytime soon. For now, the dollar continues to dominate because no clear alternative has emerged. Despite China's efforts, the US dollar remains the world's main currency. Dollar assets have dropped from 70% of global reserves in 2000 to around 60% today, showing a small shift. But even with this decline, no other currency has come close to replacing it. While countries may explore alternatives, the US dollar still holds its position as the backbone of international trade and finance. Though there is a gradual shift away from the dollar, its influence remains strong for the foreseeable future.